Joining us this morning, David Kelly, JPMorgan Asset Management's Chief Global Strategist, joins us here at Post 9. Good to see you, David. Thanks for coming in. You willing to look through the next couple of weeks of activity in terms of military action?
Over the next few weeks, yes, because there's no way this is not going to end with oil coming out of the Persian Gulf. Ultimately, the United States is going to have to come to some agreement with whoever's in charge in Iran to allow U.S. oil and everybody else, well, not so much U.S. oil, but oil go out to the world, as well as everything else that comes from the region. And the price of that is going to be that Iran is going to be able to export stuff too, because there's no other end game possible here. So I think you do have to look past that and then look towards the rest of the year. And meanwhile, I think the U.S. economy's got enough going for it to keep growing slowly from here. But you brought in, I assume, your GDP estimates for the year? A little bit, yeah, and part of it's obviously this oil effect. Also, the refunds aren't quite as strong as we thought they'd be so far. So, taking down growth a little bit in the second quarter. But remember, we could also get some further stimulus checks. We talked about tariff rebate checks. Now, the tariffs have gone or are lower than they were. But I still think we're going to get these tariff rebate checks to try to pump up the economy before the November elections. You mean the refunds from the illegal tariffs or an actual rebate? I think the refunds will slowly get back to the importers, but I think that Congress will pass a tariff rebate check or some other stimulus. I don't know how they're going to justify it, but they will do this, I think, over the course of the summer to make sure the economy is looking strong by the fourth quarter. You talked about growth. What about inflation, which is once again a big debate with oil well above $100, and it doesn't seem like it's going back down anytime soon? Not soon, but I think it's sort of 2 steps up, 3 steps down. I think by the middle of this year, by June, we could be looking at 3.5% year over year, maybe even close to 4% year over year on CPI. But by the end of the year, if we're right in oil, and you've got lower tariffs in the fourth quarter this year than last year, and you've got falling shelter costs, which we're seeing also, all that tells me 2% by the end of the year on CPI, and I actually think below 2% next year. In fact, next year I think we're going to be below 2% on both growth and inflation. Oh, you're more dovish than the Fed overall. Well, no, absolutely, because I think that this is a temporary oil issue, and I think it's a temporary tariff issue. And the end game here is this economy is really only capable of growing about 1.5% long term. So I think both of these things, both the tariffs and the oil, are going to fade over the course of the year, and we're going to just slow down as we go into 2027. So are you not a believer in any kind of AI productivity boom, or is it just too early? But the thing is, it has to be all AI productivity boom. Because of what's going on, the working age population is now shrinking by about 20,000 people per month. That means that all the economic growth is essentially going to have to come from AI productivity. And the productivity numbers are good. I think they will be good from AI, but there's only so much you can hope that it can do.